Brace yourself. The pound sterling is facing a sharp drop, approaching the 1.3500 mark against the US dollar, just as the market brims with anticipation for the latest US inflation figures. Why does this matter so much? Depending on how the U.S. Consumer Price Index, CPI data comes in, we could be looking at a pivotal moment for interest rates and currency values, one that could spark heated debate across global markets. Let's dig deeper. On Thursday, during the European trading hours, the GBP USD exchange rate is teetering close to 1.350. Traders aren't in a rush to make any bold moves. After all, the August CPI results from the United States, scheduled for release at 12:30 GMT, could dramatically sway the direction of both currencies. The US dollar itself is riding high, with its index tracking the USD against a basket of major currencies, hovering near a recent three-day peak around 98.0. That's a sign of strong underlying demand, especially with speculation mounting ahead of the latest Federal Reserve meeting. But here's where it gets controversial. Most market participants believe the Fed is gearing up to loosen its monetary policy, resuming rate cuts next week. The real guessing game is whether they'll take a cautious route with a typical 25 basis point reduction or surprise everyone with a more aggressive 50-point cut. According to the CME FedWatch tool, only about 8% of traders expect the latter, meaning there's plenty of room for discussion and differing viewpoints depending on how the inflation numbers land. Looking at projections, headline U.S. inflation is expected to accelerate year-on-year to 2.9%, up from July's 2.7%, while core CPI, which strips out volatile food and energy, should rise around 3.1%. Both monthly headline and core readings are forecast to increase 0.3%. Investors know that softer inflation data could push the Fed toward a bigger rate cut, dropping borrowing costs and shifting market dynamics, whereas unexpectedly high inflation might put those expectations on ice. And this is the part most people miss. These numbers don't just shape the Fed's next move. They ripple through everything from the dollar's strength to bond yields around the world. How is the US dollar performing against other major currencies in real time? Here's a snapshot. On Thursday, the USD is strongest against the Japanese yen, seeing a 0.47% gain. Changes versus the euro, pound, Canadian dollar, Australian dollar, Kiwi, and Swiss franc cluster in the lower single digits. To understand the data better, consider this. If USD is your base and you compare it to JPY, the percentage change reflects USD JPY's current movement. This grid provides a quick overview for anyone new to currency trading, showing how global Forex relationships shift instantly. Turning our focus to the pound. Despite Thursday's volatility, sterling remains relatively calm against its main rivals. In fact, over recent sessions, it's fared better than others, thanks in part to speculation that the Bank of England BOE may chart a different course than its American and European counterparts. Unlike the chatter surrounding rate cuts abroad, the BOE looks poised to hold firm on rates. Inflation in the UK is still a big headache, with July's annualized headline CPI jumping to 3.8%, the highest since February 2024. And this could ruffle some feathers. BOE Deputy Governor Claire Lombardelli, speaking to UK lawmakers last week, firmly warned that any expansionary moves could derail efforts to steer inflation back to the 2% target. That kind of hawkish rhetoric is less popular in today's world, where dovish policies remain in vogue elsewhere. Meanwhile, the European Central Bank is expected to freeze its deposit rate at 2% during Thursday's meeting, but they're leaving the door cracked open for possible future cuts, a scenario sure to draw mixed reactions across markets. Investors are also keenly awaiting UK GDP and factory output data, which land on Friday. June saw the economy expand 0.4%, but forecasts suggest July's growth may have stalled. On the policy front, there's another twist. UK Chancellor Rachel Reeves is reportedly planning new tax reforms to spur small business growth. Sounds good? It's complicated. The government may have to bend its fiscal rules to make this happen. Some experts argue this could push up UK gilt yields, but also warn about ballooning public debt risks. Is this risk worth the reward? The jury's still out. How does this all play out on the charts? Sterling is trading close to its 20-day exponential moving average, EMA, around 1.3489, locked within an ascending triangle pattern that signals investor indecision. Horizontal resistance is set by the July 23rd high at 1.3585, while the upward boundary begins at the August 1st low near 1.3140. The 14-day Relative Strength Index, RSI, ranging between 40 and 60, points toward a sideways trend. If sterling dips, watch for support at 1.3140. For any breakout, resistance sits near July 1st's high at 1.3800. For those unclear about inflation, it's a complex topic. Here's a quick primer. Inflation tracks how prices of everyday goods and services rise over time. Headline inflation covers everything, while core inflation ignores the volatile stuff like food and energy, which can swing wildly due to weather or politics. Central banks care most about core inflation, usually aiming to keep it around 2%. When core CPI climbs above this, interest rates tend to go up, strengthening the local currency. But here's the paradox. Higher inflation might seem bad, but it can actually lift a country's currency, as the promise of higher interest rates draws in foreign investors hunting for strong returns. Lower inflation? That usually means weaker rates and a softer currency. Gold, long considered the classic inflation hedge, behaves differently these days. Sure, people turn to gold during chaos, but when rates are rising, holding gold seems less attractive compared to earning interest elsewhere. Some say gold only wins when inflation is low and rates fall. Do you agree? A critical word to the wise. All market analysis above is speculative and not investment advice. No guidance here comes with guarantees. Markets are unpredictable and high risk, and any decision should be backed up by your own careful research. FX Street and its contributors do not offer personalized investment recommendations and disclaim liability for errors or losses. The information is intended for general awareness only, and the authors have no stake or business interests in the assets discussed. Now, let's hear from you. Do you think central banks are right to hold off on cutting rates in the face of persistent inflation? Or is it time to prioritize growth, even if that means bending the rules? Are gold's safe haven days really over? Or do you see a comeback on the horizon? Drop your take in the comments and let's spark some debate.